Everyone's chasing flashy AI stocks, but some of the biggest upside right now is hiding in plain sight. I'm talking about household names trading at a discount, quietly making moves that could drive massive gains. And in this video, we'll break down 3 that are seriously undervalued. And one of them is a 155-year-old brand that you most likely know the name of, and it may actually double this year. But more on that here in a minute. So first, let's start with Intel. This is a company that you probably know from the Intel Inside stickers on laptops. But lately, Intel's been more of a cautionary tale than a tech hero. So the stock closed at just $22 in July of 2025, which makes it a huge drop from its highs and puts it at about half its book value. So what's behind the slump? Well, Intel missed the early AI wave, letting rivals like Nvidia and AMD grab the spotlight.
In fact, Nvidia's market cap surpassed $3 trillion in 2025, while Intel's shrank below $100 billion. That's how wide the gap has grown.
Thank you, Tiara. I actually didn't realize how bad that gap had got, but that's pretty bad. But Intel also ran into manufacturing delays, and they posted a net loss in Q1 of 2025, which rattled investors. You can also add in some big spending with their chip-making business, and you get a recipe for a stock that's been hit really, really hard. But here's why things may change. So Intel's new CEO, Lip-Bu Tan, I think is how you pronounce it, is shaking things up. He's cutting costs fast. Intel is aiming to lower operating expenses to $17 billion in 2025, down from $17.5 billion last year. He's also flattening management and giving engineers more freedom, hoping to bring back that kind of scrappy, innovative spirit.
It has been a tough period for quite a long time for Intel. We fell behind on innovation. As a result, we have been too slow to adapt and to meet your needs.
If Intel can land a major customer for its new chip manufacturing business, or get its next-gen AI chips into more devices, we could see a serious turnaround. And if their new AI chips catch on, profits and the stock price will absolutely jump in a hurry. And I have to take a second here to say that if, turnarounds like this, they really catch your attention and you enjoy hearing about them, hit that subscribe button, as I track these things every day and will always try to bring them to your attention before it hits the mainstream in the media. But Intel isn't the only big name that's been beaten up. So next up, let's talk about a pharmaceutical giant that's quietly setting up for a comeback of its own. If you've ever wondered what happens when a pharmaceutical powerhouse hits a rough patch, Fizer's story is one to watch right now. So right now, Fizer's stock is trading at about $25.50 in July of 2025, which is a far cry from its highs a few years ago and puts it at a 33% discount to its fair value. So what's dragging Fizer down? Well, the big one is the drop in COVID-19 product sales. Those blockbuster vaccines and treatments, those revenues, they have faded fast. On top of that, investors are worried about upcoming patent expirations on some of Pfizer's best-selling drugs, and the company's recent $43 billion Seagen acquisition has put pressure on short-term profits. But here's why they may make a great comeback story. So Fizer is aggressively cutting costs, with $4 billion in savings already achieved, and another $500 million targeted for this year alone. They're also doubling down on their drug pipeline, especially in cancer and obesity treatments. So, for example, Fizer is pushing forward with late-stage trials for its new oral obesity drug and prioritizing new cancer therapies that could hit the market really, really soon. If even a couple of these new drugs get approved, it could mean billions of dollars in extra revenue and a major boost for the stock. Imagine picking up shares now and then, seeing Fizer announce a major breakthrough or a major approval, and suddenly that, boring pharma stock, it doesn't look so boring anymore. But what about companies outside of tech and healthcare? Well, let's check out an American classic brand that's quietly making a comeback. You ever feel like the market overlooks those old school brands? Well, Campbell Soup is a perfect example. So right now, Campbell's stock is trading at $31.25 in July 2025, which is still way below what many analysts think that it's worth. Some forecasts see it climbing as high as $56 this year, nearly doubling from current levels. So why is this classic American brand stuck in the bargain bin right now? Well, the main issue is that Campbell's snacks division has been struggling, with organic net sales in snacks dropping by about 5% last quarter. The company also took on a lot of debt to buy Sovos brands, And that's made investors nervous about the balance sheet. Plus, rising costs for things like steel cans and ingredients have really squeezed margins. And the company's revenue, it missed expectations by $60 million in Q2 of 2025, causing a noticeable dip in the stock price. But here's the thing, Campbell is quietly making some really smart moves behind the scenes. So the Sovos acquisition is already boosting sales, and the company is on track to save $120 million this year through cost cutting and efficiency programs internally. They're also investing in new products and marketing, especially in premium sauces and, more importantly, healthier options. If Campbell's new brands keep gaining traction and the snacks division can do a rebound, profits and the stock price could surge, and you could be a huge benefactor of that if you decide to dive in. Now, we've just looked at 3 undervalued stocks with serious rebound potential. But what if you're aiming to go even higher than that? Well, in this video right here, I break down 5 stocks that AI believes could 10x in value following a trajectory similar to what NVIDIA has done recently. So go check it out, and I'll see you over there.